Welcome to the X Project podcast. This is a podcast of the X Project Substack. To subscribe, please go to thexproject.substack.com. Everyone is missing the point about the Fed's rate cuts in 2024. What is the point? What does it mean? And what can we expect? Article number 17, published December 19th, 2023. In this 10 to 12 minute article, the X Project will answer these questions. 1. Why this article now? 2. What do you need to know about the U.S. Treasury market? 3. What happened on July 31st and August 1st of 2023? 4. How do the markets react? 5. Why did the markets react that way? 6. What happened in October? What is the MOVE Index? And why is it significant? 7. What did the Fed and the U.S. Treasury do about the MOVE Index spike in October? 8. And then what happened in November and December? 9. What does the X Project guy have to say? 10. Why should you care? Section 1. Why this article now? This article is about one of the most crucial points that drove the X Project into existence. It is also relatively complicated, so much in this article will be broken down later and revisited. But given last week's Fed announcement that rate cuts are coming in 2024, and the flurry of news, commentaries, and articles about it that all missed the point, the X Project needed to point out what is driving the Fed's actions and decisions, what it means, and what we can expect. But to explain what is driving the Fed's actions and decisions, we need to cover some basics and then go back a few months. Section 2. What do you need to know about the U.S. Treasury market? The U.S. Treasury market is the most important and foundational aspect of our entire global financial system, which is often described as the world's largest, deepest, and most liquid market for securities. U.S. Treasuries are viewed as highly safe assets due to the creditworthiness of the U.S. government, contributing to their widespread use as high-quality collateral in various financial transactions. This perceived safety and the market size and liquidity make U.S. Treasuries crucial in the global financial system, underpinning many other financial activities and markets. However, the perceived safety of U.S. Treasuries has been under fire. 3 primary credit rating agencies are designated as nationally recognized statistical rating agencies by the U.S. Securities and Exchange Commission. You may recall the shock Standard & Poor's gave markets when it downgraded the U.S. credit rating from AAA to AA+ in August of 2011. Back then, S&P considered the government budget deficit of more than 11% of GDP and net government debt rising to approximately 80% of GDP by 2013 to be high relative to other AAA-rated countries. Today, the U.S. government deficit to GDP ratio has come down to a little more than 5%. However, the total debt to GDP ratio is 120%. Section 3. What happened on July 31st and August 1st of 2023? On July 31st of this year, the U.S. Treasury announced that it expected to borrow $1.007 trillion in the July through September quarter and another $852 billion in the October through December quarter. This is a staggering, breathtaking, eye-watering, can't be superfluous enough $1.85 trillion in 6 months, at a time when the economy is supposedly robust and unemployment is near record lows. Right on cue, on August 1st, Fitch Ratings became the second agency to downgrade the U.S. long-term credit rating from the highest AAA to a notch lower at AA+. Notwithstanding, no one thinks there is any real risk of the U.S. defaulting on its debt by not making a coupon payment or failing to repay the bond principal. The real danger is of a soft default, whereby the U.S. meets its nominal debt obligations, but effectively reduces the real value of its debt through inflation. In such a case, while the government does not technically default on its debt, the purchasing power of the money paid back to investors is eroded due to high inflation. This situation can be considered an indirect or soft default, as it diminishes the real returns for investors holding U.S. Treasuries. Section 4. How did the markets react? The US dollar index rose 5.1% between 7/31 and 10/3. The US Treasury yield increased from 4.05% on July 31st to a high of 4.99% on October 18th. The iShares 20 plus year Treasury bond ETF with the symbol TLT fell 17.3% between July 31st and October 19th. And the S&P 500 fell 10.3% between July 31st and October 27th. Section 5. Why did the markets react that way? A simple explanation for why the markets reacted this way is that the U.S. Treasury announced it would issue a massive supply of bonds and notes and bills to the market, and this is likely to crowd out the market for U.S. dollars, as so many dollars will go to buy the enormous supply of U.S. Treasuries, and thus U.S. dollars become more scarce and their price relative to other currencies goes up. This is also likely to overwhelm the demand for U.S. Treasuries with supply, thus causing bond prices to fall and bond yields to rise. And this is likely to cause yields to rise, which puts downward pressure on equity prices because the cost of borrowing money is higher, less money to invest back into the company, and less cash flow stability, and the future discounted valuations are lower as the discount rate used for the future cash flow is higher. Furthermore, and again, very simplified, as US dollar markets get, quote, crowded out by the increasing supply of US Treasuries coming to market, demand for dollars is increasingly satisfied by other market participants liquidating assets to raise dollars, with those assets often being existing US Treasuries. This adds to the supply of US Treasuries in the market, which causes prices to go down or yields to increase. So, a rising US dollar causes US Treasury yields to go up, and rising US Treasury yields cause the US dollar to go up. Wash, rinse, and repeat until something breaks. Financial crises have been predictable outcomes countless times throughout history, as outlined in the X Project article, This Time is Different, 8 Centuries of Financial Folly. Section 6. What happened in October? What is the MOVE Index and why is it significant? Back to wash, rinse, and repeat until something breaks. What is one of the biggest things that can break then? The US Treasury market. And what does a breaking US Treasury market look like? The 30-year Treasury bond auction on October 12th is a good example. Here is a headline from an Investopedia article with key takeaways. Treasury auction results show lagging demand for bonds. Demand for the 30-year Treasury bond hit its lowest levels since December 2021 as yields came in at the highest levels since 2007. Key takeaways. Primary dealers had to buy 18.2% of the 30-year Treasury bond at the latest auction, the highest level since December 2021, signaling poor investor demand. The highest yield came in at 4.837%, the highest level since 2007. The U.S. federal deficit of $1.7 trillion contributes to bond demand worries. If you are interested in how Treasury auctions work, James Lavish, CFA, has an excellent thread on X/Twitter at the link posted in the article. Another way to see if the U.S. Treasury market is breaking is by the Merrill Option Volatility Estimate, or MOVE Index, which measures expected short-term volatility in the U.S. Treasury bond market. It was introduced by Harley Bassman of Merrill Lynch, which is now part of Bank of America, in 1994 to gauge market sentiment and predict potential price swings in the bond market. The MOVE Index calculates the implied volatility of U.S. Treasury options using a weighted average of option prices on Treasury futures across multiple maturities, 2, 5, 10, and 30 years. The index is like the VIX volatility index that lets us know when the volatility uncertainty is high or low in the stock market by monitoring options contracts. Traders and investors use the MOVE Index to watch the bond market's volatility and make informed investment decisions. Analysts also use the index to predict potential price swings in the bond market. The index is updated daily. In early October, the MOVE Index spiked to above 140, which is the fifth red circle on the far right in the chart in the article. What are the other red circles on the chart and what is their significance? Let's first look at the corresponding US dollar index chart, which is posted in the article. In the charts, each circle represents a temporary top in the MOVE Index, which is a peak in volatility or market stress or dysfunction, and a corresponding temporary top in the US dollar index. Why is this significant? Because of what we are constantly told, most people believe that the Fed's dual mandate is to manage monetary policy to promote maximum employment and stable prices. But these 5 events prove that the Fed has yet a higher mandate that supersedes both of those based on what happened and what the Fed did. The first red circle is the September 2019 overnight repo market rate spike caused by a temporary shortage of cash available in the financial system because of the deadline for quarterly corporate taxes and the issuance of new U.S. Treasuries. To stabilize the repo market, the Fed injected several $100 billion of liquidity into the repo markets and lowered the interest paid on bank reserves. The second red circle on the charts is March 2020, the COVID lockdown and market panic. The US 10-year Treasury yield surged sharply by 65 basis points from March 9th to March 18th, while the stock market kept falling. In the past, when there was a risk-off event, capital fled to and took refuge in the US Treasury market, causing prices to go up and yields to fall. But this time, there was such an urgent need for liquidity that the opposite happened, and the Fed had to step in with massive purchases of over $1 trillion of US Treasuries. The third red circle is October 2022, when the US dollar index surged to 114, the highest level in 20 years, while the US 10-year Treasury yield climbed above 4% to 4.2% for the first time since 2007. Despite the Federal Reserve still aggressively hiking rates by 75 basis points in September of 2022, and again by 75 basis points in November of 2022, and maintaining quantitative tightening during this period, the US Treasury managed to supply a little over $100 billion per month in liquidity from October through December by running down the US Treasury General Account, or TGA. The fourth red circle equal March 2023, when Signature Bank and Silicon Valley Bank failed, which were the most significant US bank failures since 2008. The Federal Reserve created and launched an emergency lending program called the Bank Term Funding Program, BTFP, to provide emergency liquidity to US depository institutions by offering loans of up to 1 year in length to US banks, savings associations, credit unions, and other eligible depository institutions that pledge US Treasuries, agency debt, mortgage-backed securities, and other qualifying assets as collateral, receiving par value for the collateral instead of the much reduced market value of those securities. And by the way, this emergency need for this funding program continues growing, according to the chart in the article, and is now at $123.76 billion. Section 7. What did the Fed and US Treasury do about the MOVE index spike in October? To start with, in 9 trading days between September 29th and October 11th, 7 Federal Reserve speakers gave speeches saying something to the effect that the bond market has been doing a lot of the tightening work for the Fed recently. That was good enough for the dollar index to peak at 107 on October 3rd, for the US 10-year Treasury yield to peak at 4.99% on October 18th, for TLT to put in a low of 82.77 on October 19th, and for the S&P 500 index to put in a low of 41.17 on October 27th. Then, on October 30th, the US Treasury announced it expected to borrow only $776 billion in the October through December quarter, down from $852 billion expected on the July 31st announcement. The US Treasury also announced it expected to borrow $816 billion in the January through March quarter. While these are still huge numbers, they were slightly better than the announcement the quarter before and slightly better than expected, so the markets were relieved. Finally, on November 1st, the US Treasury released the Treasury Borrowing Advisory Committee, TBAC, reports and recommendations. And there were 3 overarching takeaways. The first is the conclusion that the long end of the yield curve is not nearly as deep and liquid as everyone thinks. The second conclusion is that the largest marginal buyers of US Treasuries since 2021 have been highly leveraged hedge funds participating in the, quote, basis trade, where they profit on the slight difference in prices and yields when buying cash US Treasuries and selling US Treasury futures with 50 to 500 times leverage. The US Treasury needs someone to buy its debt, even if it means accepting the systemic risk that comes with the enormous amount of leverage being used. The third takeaway was the TBAC's recommendation. Quote, the committee supported meaningful deviation from the historical recommendation for 15 to 20% T-bill share. End quote. In acknowledgement of the long end of the curve not being liquid enough, the U.S. Treasury needs to shift its debt issuance toward the short end of the yield curve, including significantly more than 20% of the debt issued in short-term bills. Section 8. And then what happened in November and December? First, the good news as far as the markets are concerned is that November saw the most significant easing in financial conditions in any single month in the past 4 decades, according to the Goldman Sachs U.S. Financial Conditions Index. U.S. bonds had their best month since May 1985. The U.S. Treasury running down the TGA by 100 to 150 billion in November certainly helped, and it was no surprise everything went up: gold, Bitcoin, equities, and bonds. Except the dollar and oil, which is another story. However, there was some bad news reinforcing the TBAC's recommendation. A headline from the Wall Street Journal states, demand for 30-year treasuries proves weak, sending yields surging. The 30-year U.S. Treasury yield climbed above 4.8% on Thursday from 4.655% the prior day after a sale of $24 billion in bonds received far less demand from investors than the government is used to. Primary dealers, big banks who are obligated to finance whatever portion of a Treasury auction isn't purchased by other investors, bought nearly a quarter of the issuance, more than double their average in recent 30-year auctions, according to BMO Capital Markets. And then, by early December, it became known that November's U.S. true interest expense, which is Social Security plus Medicare plus Medicaid plus interest expense, was $345 billion versus tax receipts of only $275 billion. Section 9. What does the X Project guy have to say? First, I know I have presented an overly simplified explanation of everything so far, and there are many layers and branches of additional information regarding most of what I have shared. Still, I needed to get this all into one article, which was not easy. Secondly, I must give a big hat tip and a bow to Luke Groman at FFTT LLC. What I have shared with you is primarily distilled from at least a dozen Tree Rings reports. Okay, let's wrap this up and get back to the point, driving the Fed's actions and decisions, what it means, and what you should expect. The U.S. fiscal position is forcing the Fed to stop hiking and will be forcing the Fed to cut rates before inflation is back down to its targets. I wrote an earlier article introducing the concept, but this is what fiscal dominance is. The Fed had a choice to continue fighting its fight against inflation, but that would sacrifice the US Treasury market, which would spike yields to extremely high levels, which would send the US dollar to the moon, which would crash the economy, creating a financial crisis along the way. Inflation would be killed, deflation would be rampant, the US dollar would be very strong, and we would suffer a deep and prolonged economic depression. Instead, the Fed decided to save the US Treasury market. You should expect the US dollar to weaken in the short run, which is 3 to maybe 6 months, perhaps through next year's presidential election. This will drive US asset prices higher, GDP growth higher, US tax receipts higher, and US Treasury yields lower, as that should all help reduce the amount of US Treasury issuance. Section 10. Why should you care? You should care because what the Fed is doing will eventually bring back inflation that will be much worse than the last wave. The short run won't last long because we are in fiscal dominance. After all, it is unlikely that we will close our budget deficits, and it is doubtful that tax receipts will get above our true interest expense. In the long run, the best case scenario from here is inflation runs hot without hyperinflating for many years until our debt to GDP ratio is back down to a manageable level. Unfortunately, we live in a hyper-financialized, highly leveraged world, and so the risk of a financial crisis erupting and crashing the financial system and economy is ever present and uncomfortably high. This is why the X Project exists, to help you know what you need to know. Please help the X Project continue its mission. Please hit the heart icon indicating you like this article and podcast. Please share this article and podcast and prior articles and podcasts with anyone and everyone you know and care about. Please consider a paid subscription. Until the end of the year, all paid subscriptions come with a free 60-day trial, and you can cancel at any time. Every month, for the cost of 2 cups of coffee, the X Project will deliver 10 articles per month. That's $1 per article, helping you know in 1 to 2 hours of your time what you need to know about our changing world at the intersection of commodities, demographics, economics, energy, geopolitics, government debt and deficits, interest rates, markets, and money. If you see value in the articles published so far and in the mission of the X Project, please be generous and aggressive in referring friends. Click the link to see the rewards where you can earn free paid subscriptions, as well as the link to use for making referrals. And if you have not already done so, please at least subscribe for free. Thank you. This concludes the X Project's podcast number 17. Again, please subscribe to the X Project Substack at thexproject.substack.com.